They tell us the global financial system is stable because the numbers still move forward, because markets still open every morning, because screens still glow green and red in predictable rhythms. They tell us debt is manageable, that deficits are normal, that central banks are in control, but somewhere in the background, ticking louder than headlines, a clock is accelerating. Not a metaphorical clock, a real one. A digital counter mounted on government websites and financial dashboards around the world, counting upward every second, faster now than at any point in recorded history. And the unsettling truth is this: the clock is not the danger, the speed is. Because when systems collapse, they rarely do so with explosions. They fracture quietly. They bend, then slip, then realign in ways that only become obvious after the damage is done. And today, beneath official statements and carefully managed press releases, the machinery that once held the dollar at the center of global finance is beginning to show hairline cracks, not in one place, everywhere at once. To understand why this moment matters, we have to abandon the comforting story we've been told, that debt is just a number, that currencies are neutral tools, and that power in finance is visible, regulated, and predictable. History tells a different story. Empires don't fall when they are weak. They fall when they are leveraged beyond their ability to control the consequences. At the center of the modern financial world sits the US dollar, a currency that became more than money. It became infrastructure, oil priced in dollars, trade settled in dollars, debt issued in dollars, reserves held in dollars. By the early 21st century, more than half of global trade and nearly 90% of foreign exchange transactions involved the dollar in some form. This dominance was not accidental. It was engineered through treaties, institutions, and crises. After World War II, the Bretton Woods system established the dollar as the anchor of global finance, backed by gold and enforced by American economic and military power. Even after the gold link was severed in 1971, the system did not collapse. Instead, it evolved. The petrodollar arrangement ensured oil would be priced in dollars. Global banks structured balance sheets around dollar liquidity. Central banks accumulated U.S. treasuries as reserves, not because they were profitable, but because they were liquid, deep, and politically safe. For decades, this system worked because trust outweighed math. But trust is not infinite, and math eventually demands payment. Today, global debt has crossed levels that would have been considered unthinkable a generation ago. Combined public and private debt now exceeds $300 trillion, more than 3 times global GDP. Governments alone account for well over $90 trillion, with the fastest growth concentrated in the world's largest economies. The United States, the issuer of the world's reserve currency, now carries federal debt exceeding $34 trillion, growing by trillions per year. Interest payments alone rival or exceed national defense budgets. These are not abstract figures. They represent claims on future productivity, future taxation, and future stability, and they are compounding at a moment when growth is slowing, demographics are aging, and geopolitical trust is eroding. The official explanation is reassuring. Debt is sustainable, we're told, because it's denominated in our own currency, because markets still buy government bonds, because inflation can be managed, because central banks have tools. But here is the uncomfortable detail often omitted. The system now depends on constant intervention to prevent visible stress. Since the 2008 financial crisis, central banks have expanded their balance sheets by tens of trillions of dollars through quantitative easing, emergency lending facilities, and asset purchases. These actions stabilized markets, but they also rewired incentives. Risk was socialized, losses were absorbed, and debt, instead of being cleared, was rolled forward. Each crisis solved the last one by borrowing from the future. The pandemic accelerated this trend dramatically. Governments shut down economies and replaced income with debt-financed stimulus at a scale never attempted before. In just a few years, deficits that once would have triggered panic were normalized. The global debt clock didn't just tick upward, it jumped. And yet, the most important shift was not the size of the debt. It was who began to question the system that supported it. Quietly, over the past decade, major economies have started reducing their reliance on the dollar. Central banks that once increased dollar reserves without hesitation began diversifying. Gold purchases surged to multi-decade highs. Bilateral trade agreements increasingly bypassed the dollar entirely. Energy deals were settled in local currencies. Digital payment rails were built outside traditional Western-controlled systems. These moves were rarely announced as rebellion. They were framed as risk management, as efficiency, as modernization. But taken together, they form a pattern. When Russia was cut off from dollar settlement systems and had hundreds of billions in reserves frozen, the message was unmistakable. Dollar assets are not neutral. They are political. And once that reality is acknowledged, the incentive structure changes. Countries that once saw dollar reserves as protection began to see them as exposure. This doesn't mean the dollar is collapsing tomorrow. Reserve currencies do not vanish overnight. They erode. slowly at first, then suddenly. The mechanism is subtle. As fewer transactions require dollars, global demand softens at the margin. As fewer countries recycle trade surpluses into U.S. treasuries, financing costs rise. As interest payments consume larger portions of government budgets, fiscal flexibility shrinks. And as central banks step in to stabilize bond markets, currency credibility weakens. This is not theory. It has happened before. The British pound followed a similar arc. In the 19th century, it was the backbone of global trade. London was the financial center of the world. British debt was trusted implicitly. But 2 world wars, rising deficits, and shifting power structures gradually undermined that dominance. The pound didn't collapse, it faded. And when it did, the world barely noticed until it was irreversible. The United States differs in scale, but not in principle. The dollar's power rests on confidence, liquidity, and enforcement. All 3 are under strain. Liquidity now depends on central bank intervention. Confidence is challenged by persistent inflation and political polarization. Enforcement increasingly pushes countries to seek alternatives. Even within the U.S., cracks are forming. Debt ceiling crises have become routine, budget negotiations threaten shutdowns, long-term obligations for pensions, healthcare, and interest far exceed projected revenues. These are structural issues, not cyclical ones. And here's the part rarely discussed. Modern debt systems are not designed to be repaid. They are designed to be rolled. Government bonds are issued with the expectation that they will be refinanced indefinitely. This works as long as growth exceeds interest costs and confidence remains intact. When either condition fails, the system shifts from stability to fragility. We are now approaching that boundary. As interest rates rose to combat inflation, servicing existing debt became dramatically more expensive. Governments faced a dilemma: allow rates to remain high and risk fiscal stress, or intervene and risk currency debasement. This is not a choice between good and bad. It is a choice between visible pain now and hidden pain later. Historically, systems choose later. And that choice has consequences. Currency debasement doesn't always look like hyperinflation. More often, it appears as asset inflation, widening inequality, and declining purchasing power masked by official statistics. Wealth concentrates not because productivity surges, but because financial assets are closest to the source of new money. This dynamic reshapes societies. Trust erodes. Political polarization intensifies. Institutions lose credibility. Meanwhile, technology accelerates everything. Digital currencies, blockchain settlement systems, and real-time cross-border payment networks reduce the friction that once protected dominant currencies. Central bank digital currencies promise efficiency, but also introduce new forms of control and surveillance. Private digital assets challenge traditional money, not by replacing it, but by exposing its weaknesses. The dollar's role as the default intermediary becomes less essential when alternatives are fast, cheap, and politically neutral. This doesn't mean a single replacement will emerge. The future is likely fragmented. Regional systems, multiple reserve assets, commodity-backed trade, digital settlement layers, a world less unified, less predictable, and more volatile. And volatility is the enemy of debt. High debt systems require stability, predictable cash flows, low rates, trust. When volatility increases, risk premiums rise. Borrowing becomes harder. Refinancing becomes uncertain. This is why the acceleration of the global debt clock matters now, not because the number is big, but because the environment that sustained it is changing. Insiders understand this. Institutional behavior reveals it. Central banks accumulate gold quietly. Sovereign wealth funds diversify away from dollar assets. Multinational corporations hedge currency exposure more aggressively. Supply chains are reshored, not just for resilience, but for control. These are defensive moves, and defense signals anticipation. The official narrative insists the system is resilient, that reforms are possible, that growth will return, that innovation will save us. Perhaps it will. But history suggests that transitions of this magnitude are rarely smooth. Every monetary system eventually confronts the limits of its assumptions. The assumption that debt can grow faster than income indefinitely. The assumption that confidence can be commanded. The assumption that power structures remain static. We are now watching those assumptions being tested in real time. The fracture of dollar control is not a collapse. It is a redistribution of leverage, a slow shift from a unipolar financial world to a multipolar one. And in that shift, rules change. Who pays for past promises? Who absorbs losses? Who controls liquidity when trust breaks? These questions define eras. The global debt clock will continue to tick, faster, louder. But the real story is not the number, it's the response. Will policymakers confront structural imbalances or postpone them again? Will currencies compete through stability or coercion? Will technology decentralize power or concentrate it further? This moment will be remembered not for a single crash, but for a series of quiet decisions that reshaped the architecture of money itself. And decades from now, when historians look back, they may mark this period not as the end of the dollar, but as the moment its unquestioned dominance ended. when the clock accelerated, when control fractured, and when the future of money became uncertain again. Because once faith in permanence is broken, systems don't return to what they were. They evolve into something else, and we are standing at that threshold now. Subscribe to the channel if you want to understand what's changing before it's explained to you. This channel tracks the shifts most narratives ignore. No hype, no promises, just patterns. If you're still watching, you already belong here.